Hey guys, I am so happy that you're watching this video. I think you're going to get a ton of information and a lot of good stuff that you can share with your clients, whether they be buyers, sellers, borrowers. I think that this is really good information to pass along and it really puts things into perspective. So, what we're going to talk about here is March Madness, right? It's been kind of mad. Things have been uncertain since February and they really have gotten pretty volatile in March, and we're going to talk about why and what to expect moving forward. So, why rates are, what they're doing, and what to expect moving forward. So, basically, what's happening is that the S&P 500 has dropped 30% in the last couple of weeks, and this is due to folks just not knowing the economic impact of our global situation. This isn't just national. This is, in fact, it's global. And so we're seeing this global volatility everywhere in the world. And it's just been a roller coaster. I mean, when you look at this candlestick chart, initially there was almost no change in rates, right? And then over the last couple of weeks, we've just been up and down, up and down. And mortgage bonds have been fluctuating wildly between like a 4% and a 3% coupon price. This is what's called a candlestick chart, and red days are days where bonds close lower than they open. So they would open up here, trade as high as this and as low as this, and close down here. And green days are positive days where they would have opened down here, traded as high as this and as low as this, and closed right here. So you can see that they've just been kind of going nuts. It's been really, really volatile. And when we look back, I mean, if we just look at the S&P 4 years ago in 2016, we can see we are still higher. And if we go back to right around, coming out of that financial crisis, here we are, right? So if we put this into perspective for our clients, I understand and I get it that things are scary right now and clients really wonder what's going on. But we would have to have literally another 50% drop in stocks to get to where we were in 2012. So the number one takeaway is to help put things into perspective for your clients. The financial crisis in 2012, I mean, we had down here during the financial crisis, the S&P 500 was at a 750. We're at a 2375 now. So it's not as bad as what we were. And I feel like if we just put this into perspective for people, it would really help calm their fears. I think that is really, really important. And the number two thing that I think is really important is that, we have to explain to our clients that lenders don't set the rates, okay? Lenders don't set the mortgage rates. What drives interest rates is the mortgage-backed securities market. So this is the money market, or this is the mortgage money flow chart. And basically what it explains is, if a borrower borrows money at around 4%, the bond investor usually makes 1% less than what the borrower is paying. And the reason is because Fannie Mae has to take their cut, the mortgage company has to take their cut. So when we look here at the mortgage-backed security or securitization process, the bond investor ends up with a yield, like I said, that's about 1% less. Sometimes it's a 0.5% less. So what happens is, the borrower, the lender lends the borrower the mortgage, sells all of the paper, pulls it together, sells it all back to Fannie Mae, who then issues mortgage-backed securities for investors to invest in on the secondary market. So Fannie Mae will issue bonds, and they're called coupons, all right? So if lenders are issuing a lot of 4% bonds, or a lot of 4% mortgages, if lenders are issuing 4% mortgages, then Fannie Mae issues bonds to the investors saying, who wants to invest in my mortgage-backed securities and earn 3% yield on their money? So that these loans, that way they can create more money to lend back to the banks. That's the circle right there. But if rates drop, and let's say people are only paying 3% on their mortgages, well, then Fannie Mae sells a 2.5% coupon on the mortgage-backed securities market. Okay? So what happens is when we, meaning us lenders, watch the bond prices, we pick a coupon that is roughly 0.5% to 1% lower than the rates we are quoting. So if we're quoting 4% rates to our clients, then we would watch the 3% coupon, because that would be what the bond investors are investing in when they're buying bonds on the secondary bond market. So part of the volatility and confusion is that lenders are continuously changing the coupon because the rates are so volatile right now. So if we look at, 4 weeks ago, let me go back here. If we look at, 4 weeks ago, we were watching, the 3% coupon, right? And then it just started doing this, okay? So it made it really, really, really hard for lenders to pick a coupon to watch and keep up with the market because it got so volatile and was changing so fast. All of that was creating some confusion, because when things are changing so quickly in a day, it's really hard for lenders to pick a coupon to watch when it's constantly changing. So that's the first thing I'd like to explain to you today, is that part of the volatility in rates is just really how fast the market is changing on legitimately an hourly basis. So when we have days like this, or huge day, it's really hard to kind of pick a coupon to watch and price to. So that's one challenge for lenders. The next thing is, I want to address the question, why aren't mortgage rates following the 10-year treasuries as they typically do? All right. So historically, people have used the 10-year treasury as a good indicator of what mortgage rates are doing. So what happens is, when the coronavirus fears hit the U.S. market, the 10-year treasury plummeted from around 1.8 up here to down to 0.6, and as low as like a 0.38 on a 10-year treasury note, which is like 1.5% lower than where it was at the beginning of the year. All right. So theoretically, if mortgage rates follow the 10-year treasury, you would think, gosh, mortgage rates should be like 1.5% lower if the 10-year treasury is 1.5% lower. But there are some reasons why. But that theory is putting a lot of confusion into the market, because the media says that the 10-year treasury is lower, so therefore mortgage rates should be lower. And that's not totally true. The reasons that it's not true, there are two reasons. So the first reason I want to talk about is the default risk here. Okay, so the default risk, you have to look at U.S. Treasuries. So the 10-year Treasury is the interest rate that the government pays when they want to borrow money for 10 years or 20 years or 30 years. It just depends. So whatever they buy, that the U.S. Treasury bonds is what they pay. So if the government wants to borrow money, they don't go to a bank and say, can I get a loan? What they do is they issue U.S. Treasury bonds on the bond market and say, who wants to invest in my debt? All right, that's what the U.S. Treasury is. So people who invest in treasuries are basically loaning money to the federal government for 10 years on a 10-year treasury, or 30 years on a 30-year treasury, and so on. the thing you have to understand about the US government is that in 239 years, the US government has never once defaulted on any of its loans. So they have a 239-year credit history of perfect credit history, no defaults. So really the 10-year treasury has a zero default risk. On the other hand, when you're looking at mortgage bonds, they do have a default risk, right? So what if borrowers decide they don't want to pay their mortgages anymore? That's the risk that you take, and that is one of the reasons why the yields are spreading between the mortgage-backed securities and the 10-year treasury, because the default risk is unknown, right? So investors are saying, well, if I'm paying 2%, if I'm yielding 2% on a US Treasury and you want me to buy bonds as well, there's default risk in that. So I want you to pay me more on my bonds than you're paying me on the US Treasury because it's a riskier investment. Does that make sense? So if you were talking to clients, you don't really need to go into all of this detail. I mean, I'm giving you guys this because you're professionals and you'll want to simplify this for them. So if you need to email me, I have some articles that you can use to present to them, and that really simplifies, why mortgage rates don't always follow the 10-year treasury. I also have a really good article that you guys can email me for on, how the Fed rate actually affects mortgage-backed securities. Because that was another thing that we got. People said, well, the Feds lowered their rates to 0%, so mortgages should be 0% too. And that's just simply not the case. I actually have like a whole set of like coronavirus tools that if you need, you can definitely email me for, and I am happy to share with you. So, but just to go a little bit more in depth for you guys, initially what happened in late February is bond prices began to improve, right? So they began reaching their high right here in early March. So they gained 300 basis points in 3 weeks, and that means a rate quoted in early March was about 3 points less in fee, or 0.75% rate lower in early March than it was in mid-February. Okay, so how this works is, the way that we get these translations is if bond prices go up by 100 basis points, this means that the rate sheet prices that lenders look at get better by 100 basis points in fee or 0.25% in interest rate, okay? So if you were quoting a 4% interest rate with a 1-point fee today and bond prices go up by 100 basis points, your rate sheet should be 4% rate with no fee, okay? Now, if bond prices were to go down in the same way, right? So when we hit here and they started to go down, the same is true. They get more expensive. All right. So you can really look at it. It flips both ways. So when you're looking here and we got 0.75% better in interest rate, and then literally very quickly overnight and leading into like mid-March, we got the same or worse in rates. So it can work both ways. Now, The other thing that you need to know is that at this point right here, when rates decreased so much, what happened was 6 trillion, if not more, mortgages became eligible for refinance. And just to put this into perspective for you guys, in all of 2019, so all of last year, for both purchases and refinances, the entire industry did about $2 trillion in volume in loans for the whole year. So over 12 months, $2 trillion in volume. Then in a matter of literally just a few days, right? In a matter of just a few days, all of a sudden, $6 trillion became eligible for refinance. So how does the industry process 3 to 5 times the volume it did in 12 months in just a matter of 1 month? All right. Now, this created a huge concern because bond investors, they got spooked, right? So they were literally thinking that all of last year they bought around $2 trillion in bonds, and now the industry is going to expect them to purchase $6 trillion in new bonds literally in the next 2 months. So they got spooked and said, there's no way we can buy all of those mortgage bonds. All right. So what happened was mortgage bonds began to lose their value, and they dropped another 150 basis points in 1 day. So that means that a rate quoted at 4 p.m. in the afternoon could have cost literally 1.5 points more than a rate quoted at 10 a.m. that day. So like literally in a matter of 3-4 hours, the bond prices changed, and you know, they plummeted. They plummeted because of the fear of supply that was going to hit the market. So the bond investors got spooked. That drove the prices down, and we were getting a market reprice notices literally by the hour. By the hour, we were getting reprices, and rates were increasing literally by the hour that day. So basically, that was one of the reasons is the bond investors were like, how in the world can we keep up with this demand? There is no way we can keep up with this demand. So then what happened was the feds got involved, okay? And they announced a series of actions. And so number one, they're going to reinstate the bond buying program that they had to help pull us out of the financial crisis. So what happened was after the financial crisis in 2008, the feds began to purchase mortgage-backed securities. And within 6 years of starting that program, the feds owned about $4 trillion in assets. But only 1.64 trillion of that was in mortgage-backed securities. So the rest was in U.S. Treasuries. In 2018, as you all know, they started their taper program, where they were going to stop buying purchases. They were going to stop buying bonds, rather. Now, what they're saying here is they're going to invest $700 billion in more bonds. They're going to put $200 billion in mortgage-backed securities, and they're going to put $500 billion in U.S. Treasuries. So if people pay, and then they also said if people pay off their mortgages, but they were going to reinvest that principal back into the mortgage-backed securities market. Okay, so now the balance sheet is set to grow by another $700 billion in the next couple of months. They thought that this should calm the market, calm the fears, and lower the interest rates. All right. Now, in addition to that, they also ordered short-term rates down to 0%. So far, So for instance, the prime rate that's used for HELOCs, that went dramatically down. Many businesses who have loans that are indexed to the federal prime rate, that went down too. So their thinking was that if businesses were paying a lower interest rate on their loans, then they could basically use that money that they're saving to stimulate the economy. But here's the thing, like, that doesn't impact mortgage rates. Okay, that doesn't impact the mortgage rates. The bond buying program is what has the potential to impact mortgage rates. All right. And then they instructed their easy money policy. So basically saying to banks in the system that, normally we require X amount of money in reserves, but now zero money is in reserves. Zero is required for assets in reserves. Now they can loan out all of their assets to other banks and businesses. So the Fed thought, if we do these things, it should help calm fears in the markets, stimulate the economy, and create some liquidity for people. So that was their thinking. All right. But what happened was, sorry, this one next. So that was their thinking. And initially it did work, right? Initially it worked for about one day. But then bond prices over the next week, they just plummeted. Again, why? It's because investors were spooked. All right. So not only are there a huge amount of mortgage-backed securities set to hit the market, now the U.S. government is going to issue an additional $1 trillion in bonds for the proposed stimulus plan that's currently, being debated on in Congress. We're hearing that it's making headway, even after initially being turned down, but our deficit was scheduled to be $1 trillion, and now it's scheduled to be about $2 trillion. So $1 trillion in U.S. Treasuries, and if the Fed only buys half of that, who's going to buy the other half, right? The investors have to. And the investors are spooked because there is so much coming at them in such a short period of time. The treasury bonds that are going to be issued for the stimulus package, they're not coming over time. They're literally coming in the next couple of weeks because the idea was to get checks out to the U.S. citizens in April. So they have to issue those bonds right away. And not only in the U.S., right? So that's what's happening in the U.S., but other countries are coming up with stimulus plans too. So what if Europe and Italy and Germany do something similar to stimulate their economies, because their economies are shut down too? What if Asia does the same thing? And what if all of these countries are issuing treasury bonds? Who's going to absorb that? And the investors are worried about who's going to pay for that. So there's a lot to add to the mix. The other thing too that investors are a little spooked about is the global demand for dollars. So, for example, the U.S. has a trade deficit with China of, let's say, $500 billion. This means that consumers are buying $500 billion of goods from China. And for example, now if the trade, all of a sudden people stop buying stuff, well, because maybe there is no supply, maybe China can't keep up with the supply. Okay, but if that happens, then because the economics across the world are all shut down and all trade deficits that the U.S. has with other countries are greatly reduced. Okay, so what that means is countries, they might not have the surplus to invest in U.S. treasuries anymore. So, with the trade deficit, theoretically what happens is we buy Chinese products, for example, and then China takes that money and invests it in our bonds, right? But if there isn't the supply to buy those products, then there won't be the money to invest in the treasuries, and therefore the investors are feeling like they have to make up the difference, okay? So all of these things and all of these reasons are legitimate fears that bond investors have, and this is why the rates are bouncing all over the place. This is why, we're going from 3% to 4% and back and forth and back and forth. So these are the reasons why. So the big question is, what are we going to expect? And basic answer is what we expect for the next couple of weeks or even maybe the next month or two is more volatility. So what's been happening in the last few weeks is not immediately going to go away. It's going to last for a while, and that's why it's important that you stay up to date. If you want, I can provide you weekly market updates to anyone who wants them. You can just email me for that at heather.ducker@homebridge.com, and those come out every single Monday, and I am happy to share that information with you. So now, that's what's going on with the mortgage market and mortgage rates. They're just extremely volatile, and the big reason is that investors are overwhelmed, and so when they get overwhelmed, they just pull out, and then there's little demand for bonds right now. So the Feds have committed to doing whatever it is they can. They're fully invested and they're supporting us. So they're doing all that they can, but let's talk about the housing market, because I'm hearing a lot of fear about that, and I just want to quickly touch base on that too, okay? So what about the housing market, and what about prices, all right? So here is a chart that I really like. So basically, the best case scenario is that we don't have another housing crisis. And this is a great chart to study, because the reason that most people think there won't be another housing crisis is because of this, okay? So when we look at housing starts, you know what? No wonder I skipped. Okay, sorry. I'm totally skipped a page. Here we go. Okay, so this chart I really like because we can use it to calm fears, okay? So even if there is another housing crisis like there was in 2007 and 8 and the house prices tumble, the long-term rate of appreciation is about 3.84 to 4%. So if someone buys a house today and it loses value, but it improves over the next year or the year after, well, if they're owning their house for 7 to 10 years, then they can reasonably expect to actually make money on that house, right? So it's not necessarily what the prices are going to do now in 10 or in 12 months, but we just need to be having a conversation with the buyers of these properties of, what about in 7 to 10 years, right? So, down here, everybody thought that it was hopeless, that they would never, ever make money on real estate ever again. But, we quickly recovered, and this isn't going to be any different, right? So I would just use this slide to just calm fears and say, if it loses in the next 10, 12 months, then we need to keep our eyes on the long term, right? We need to keep it on the long term. Most people are in their houses 7 to 10 years, and that's a long time. And historically, in the last 30 years, people make 3.8% on their homes, that factors in this big drop right here. So people can reasonably expect to still make money on their properties, okay? So the best case scenario is that we don't have another housing crisis. In fact, I think that this is another great chart to study, because this is the reason most think that there will not be another housing crisis, okay? So by last crisis, right in here, there was an oversupply of houses in the housing market. So the long-term average of new housing starts units coming into the market is about 1.5 million units a year, okay? And that's about what we need to replace the obsolete supply, so houses that are just being torn down for one reason or another, and also to account for the new households being formed, so like millennials, people getting married, people moving out of their parents' houses, or people moving out of the dorms from college, right? So we typically need like $1.5 million in units per year. Before the last crisis, we were up above 2.2 million units per year, which basically led to oversupply of homes in the market. And during the plummet of the market, you can see here that the housing they just plummeted because the surplus was being absorbed. This oversupply was being absorbed, and that's why it went down, okay? But over the last several years, we've slowly started building more. So now we're pretty much about where we want to be at about 1.5 million new starts per year. So if we were to take a plunge, it's not likely to affect much in the way of value because of the fact that we do not have this surplus of inventory. We have exactly what we need, and the demand for the housing isn't likely to go away because people need somewhere to live, right? So the other thing that we can look at before I get into that, getting ahead of myself again. So we can also look at the home ownership rate, okay? So we look at, the house appreciation, we look at the housing starts, and then we look at the home ownership rate. Back right before the crash, our home ownership rate was close to 70%, all right? Now we're down 64, 65%. So what this means is that we have some room to grow. So up here, 70% of people, 70% of our population owning homes, we have room to wiggle here. We're not capped like we were back then, all right? So with home ownership rates being a little bit lower right now, that's likely to kind of help us through this, okay? So that's why I think it's really important that we all use a buy versus rent calculator when we're talking to homeowners about the housing market. I think it's really important that we use this opportunity to set ourselves ahead as professionals, and that we help them compare the cost of owning versus the cost of renting, because people have to live somewhere. So if they have to live somewhere, they're either paying rent or they're paying a mortgage on their own home. So which makes the most sense to them? That's what we have to decide, all right? So this is where I would just encourage you to keep your nose to the ground, get really innovative with your marketing, do things like virtual tours and whatever you can use to leverage conference calls and Zoom and anything that you can do to stay in front of your clients. And this is probably a time not to stop communication with them. It's probably a time to amp that up, communicate more, right? So that's what we do right now. We get innovative. We use our technology. We encourage people to stay the course, right? They have to live somewhere. And the other thing that you can do is you can reach to your Homebridge loan officer if you have any questions. So I have all of their emails right here. Here's my email: Robert Hedges, Adrian Weiss, Mark Major, Krista Young, Sheila Miller. We are all here to answer your questions and help you through this. And we have a lot of marketing material. We have a lot of data. We have a lot of things. Also, watch my Facebook Instagram and my YouTube pages. Here they are. Follow them and subscribe to them, guys, because I'm going to be keeping some really updated information on all of those. That's my goal through this, is to support you and get you the information that you need so that you can continue to sell those houses. Reach out if you have any questions. Otherwise, go sell a house or two, help a buyer or two. We're making big impacts in people's lives, and this might be when they need it the most. So don't stop, and always reach out for support, and we are here to help you. Thanks again for watching, guys. I hope you have a wonderful day.